Hello students, in today's lecture I'll be teaching one capital budgeting sum which will cover all the methods. So let us start with the sum. I'll read the sum. T Limited is considering investment in project requiring capital outlay of rupees 2 lakhs. So this is initial. So let's start with the sum. T Limited is considering investment in a project requiring capital outlay of rupees 2 lakhs. Forecast for annual income after depreciation but before tax is as follows. So we are given profits. We have after charging depreciation but before charging tax. Okay. So first of all, we have to make one table for calculating cash inflows. So I'll make one table. It will showing calculation of cash inflows. Okay. The very first column will be here. In this sum, we are given information about 5 years. We are given net profit after depreciation but before tax. So we are given net profit before tax. Okay. Amounts are 1 lakh, 1 lakh, 80,000, 80,000, and 40,000. Okay. Since it is net profit before tax, we have to charge tax. Okay. Tax rate is given at 50%. So I'll apply tax at the rate of 50%. So 50% of net profit before tax always. So 1 lakh into 50%. Okay. Accordingly, I will calculate for all the 5 years. Then you will get net profit after tax. Okay. So net profit before tax minus tax will give you net profit after tax. So for all the five years, I'll compute like this. Okay. Then we have to add back depreciation. We have to add back depreciation with net profit after tax so as to get cash inflow. Okay. The formula for cash inflow is NPAT plus depreciation. Now we have to calculate depreciation. It is not given in the sum. So I will give you the formula for calculating depreciation. Depreciation is equal to cost of the project, or we call it initial investment, minus scrap value in case it is given in the sum, upon life of the project. So this project is generating income for 5 years. So life will be 5 years. So let us see. Cost is given in the first line itself, which is 2 lakhs. Scrap value is not given, so we'll consider it as 0. Upon estimated life, it is 5 years. So depreciation will be 2 lakhs divided by 5. 40,000. In all the columns, we'll write 40,000 is our depreciation per annum. Okay. Now to get cash inflow, we have to add net profit after tax and depreciation. We'll get cash inflow 50,000 plus 50,000. So your cash inflow is 90,000. So similarly, I will calculate for all other years. Okay. I hope this is clear. Then we need one more column, that is cumulative cash inflow. Is cumulative cash inflows. Okay. We have to go on adding cash flow each year. In first year we have 90,000, so I'll just add 90,000. In second year we have opening 90,000 plus second year's 90,000. So cumulative figure is 1,80,000. Okay. I hope you are able to hear me, students. Just type yes in chat box if you could hear me. And please type your name in chat so that I'll come to know how many of you are attending. So cumulative figure for third year will be second year figure plus third year's cash inflow. Likewise, I will calculate for all the 5 years. If you add cash inflows, you will get the same amount as that of cumulative cash inflow in last year, 4 lakh. Clear? Okay. Now, we will be solving one sum with all the methods. And even in exam, I'll try to give such sum in which all the methods are there. Instead of giving 2 projects and repeating the same formulas, I prefer to have only one machine or one project with all the 5 formulas, 5 words. Okay. So for this sum, I'll be showing you all the 5 formulas with the same sum. Okay, traditional as well as modern. Okay, so since this table is done, I'll just slide it to my left. Different methods. Okay, for this sum. First one is payback period method. Formula for payback period is complete years plus shortfall in initial investment on next year's cash inflow. Okay. Now, to solve this method, what we have to do, we have to go to cumulative cash inflow column. Okay. Our initial investment is 2 lakh rupees. So we have to put a box against the amount which is closest to 2 lakh rupees. And if you see in cumulative, we have 90,000, 1,80,000, 2,60,000 accordingly. Okay. So which is closest to 2 lakh 1,80,000. So put a box around it. Okay. I'll just make it bold. Okay. And uh, the consecutive years cash inflow. These two boxes are being put in the given table. Clear? First one in cumulative column, the figure which is closest to the cost of the project or initial investment, which is in this sum 1,80,000, which is closest to 2 lakhs. Remember that you should not tick mark the amount which is uh, surpass the initial investment. Okay, suppose third year had shown 2,05,000. Still, I would have marked 1,80,000 as the closest one. Okay, the cumulative figure should not have surpassed the 2 lakh mark. Okay, in this sum. And next year's cash inflow will be marked in cash inflow column. Okay, so two markings are required for this first method. Okay, so to recover 2 lakh rupees, for sure we will need complete 2 years as the first marking is in second year. So complete 2 years will be required minimum, isn't it? Then still some amount is to be recovered. How much is it to be recovered? Out of 2 lakh, we have recovered 1,80,000. So still 20,000 is yet to be recovered. So that is a shortfall in initial investment. Have we got it? 2 lakhs minus 1,80,000. This is how we got it. Okay, upon next year's cash inflow, which is 80,000. Okay. So if you solve the fraction, we'll see how much you get. 20,000 divided by 80,000. 0.25. So it will be 2.25 years. I hope this is clear. For first three methods, you need to have this table. Okay, and just revise how we got this table. Always look for the profit or its denomination, what is given to us. In this sum, the profit was income after depreciation but before tax. So it was given net profit before tax. Okay, after depreciation. Clear? So we started with net profit before tax. We deducted tax at the rate of 50%. We got NPAT. To get cash inflow, we have to add back depreciation. As depreciation is a non-cash expense, we have to add it back. For that much is saving in the company itself. So we added depreciation to NPAT. We got cash inflow. Then we had one more column, that is cumulative cash inflow column. Okay. Once you make this table, we started with the first method, which is payback period method. Since the cash inflows are given 90, 90, 80, 80, okay, had there been one common cash inflow figure for all the years, it would have become very easier for us to calculate payback period. In that case, suppose we had 50,000 as cash inflow for all the years, then payback period would have been very simple, 2 lakhs divided by 50,000. Okay, so 4 years. Simply got it. No need to have that big formula. Okay, simply initial investment upon cash inflow per annum. That would have been the formula. But you won't be expecting such sum in the paper. Okay, you will have sum which has uneven cash inflows. Clear? So you have to make such table. And first method, you have to calculate like this only. First one is payback period method. Formula is complete years plus shortfall in initial investment upon next year's cash inflow. Complete years means the figure which is closest to the initial investment. That year will be considered as minimum. So minimum 2 years will be required. Plus, how much is the shortfall? 20,000 divided by next year's cash inflow. If we solve this fraction, we get 0.25 as answer. So your final answer is 2 years plus 0.25. That is 2.25 years. Okay, clear? Now, second method is post payback profitability. Here it is simple. Total cash inflows minus initial investment. Okay, so total cash inflow we have is 4 lakh rupees minus initial investment is 2 lakhs. So our answer is 2 lakhs. Clear? This project tells us what is the surplus after recovering your cost. Clear? Now third method. In the question, for third method, they have given both the formulas. First, by using original investment and average investment. I'll show you both of them. This methods to the right, that we get some space here. Now third method. They have called it rate of return on original investment and rate of return on average investment. And it is nothing but your ARR. Okay. I'll write here ARR stands for annual rate of return or average rate of return or accounting rate of return, which is the same. Okay. Formula for ARR is average annual profit after tax upon students. Here you have two options. Either you take original investment, which is 2 lakh rupees, or average investment, opening plus closing divided by 2. So in this time, it asks you to calculate by both the methods. You can see in the sum B and C, the rate of return on original investment as well as average investment. So I'll show you by both the methods. Okay. So first I'll show you with the original method. So average annual profit after tax upon original investment into 100 Okay. Now, how to get average annual profit after tax? You have to go to the table, calculate average of profit after tax figures. Okay. So first, we'll take total. So total PAT is ₹2 lakh. Okay. So I'll make a note here. Average annual profit after tax is equal to total profit, total PAT is L, right, upon number of years. So total profit after tax is 2 lakh rupees upon total number of years is 5 years. So your answer is 40,000. Okay. So now we got average annual PAT, which is 40,000 upon original investment is how much? 2 lakh rupees into 100. Okay. So please solve this. You will get the answer. So 40,000 upon 2 lakhs into 100. 20%. Okay. Clear? Now, instead of this, if we had to use average investment instead of original investment, the formula will change a bit. What I'll do, I'll just put the formula here. Okay. Instead of original investment, it will be average investment. Okay. Yeah. Now to get average investment, formula is average investment. In the exam, I'll leave it up to you which formula you want to use for ARR. You can do it on original investment as well as average investment. I will not specify. Okay, so you can use any of these two methods. So average investment is nothing but opening investment, or I'll use rather more simpler formula, initial investment minus scrap okay, this will be easier for you to remember. Okay, friends. So here initial investment is 2 lakh rupees plus that is not there upon 2. So your answer is 1 lakh rupees. Okay. So average annual profit after tax we have already calculated 40,000 upon average investment which is 1 lakh rupees into 100. So it is 40%. Okay, students. So now talking about both the methods, now to calculate ARR, you can use original investment as well as average investment. Okay. Now these three methods which are talking now are traditional methods. Okay. I'll teach you the modern techniques. That will be 4, 5, and 6. Okay. So if you want to take a screenshot and just reduce the size and just copy those related to formula here so that you can have one common screenshot. And it fits in your screen. Okay. So Veena is asking how to calculate cash inflows. Will Veena, please pay attention. Will please explain again. In the sum, you have to first look what is given to you, which level profit is given to you. Okay? So in this question, if you read, this question. If you read in the second line, it is given annual income after depreciation but before tax. Okay, first of all, you have to reach till net profit after tax figure. Okay, so what is given to you before tax? They have already charged depreciation, but they are yet to deduct tax. Okay, so what you have to do? You have to make one table. Okay, first column will be for years. Okay, first column is for years. We have 5 years. Then column for the profit, the level at which it is given. It is given at net profit before tax. So I wrote all the 5 years figures. Okay. Then we have to first deduct tax. Okay, because we have to reach till net profit after tax figure. So tax rate is given as 50%. So always calculate tax on net profit before tax value for respective years. Okay. So I have taken 50% of each year's tax. So once I subtract tax from net profit before tax, I'll get net profit after tax figures. Clear? So this is my profit for every year for these 5 years. Each year, clear? Now how to get cash inflow? Cash inflow is profit after adding back all the non-cash expenses. So in our sum, depreciation is a non-cash expense which you have to add back because we haven't paid depreciation to any third party. So that expense already shown on the debit side of P&L as expense. It is not an outflow of cash. So we have to add it back to get inflow. So cash expense not incurred is added as cash inflow. So we have to add depreciation. Now how to calculate depreciation? For that formula is there. The table. I have given the depreciation formula: cost or initial investment minus scrap upon life of the project. Okay. So initial investment is 2 lakhs minus scrap 0 upon 5. Okay. Life is 5 years. As cash inflows are given for 5 years, life is 5 years. So I get 40,000 as my depreciation. Clear? So I added back depreciation each year's profit after tax figure. So I got cash inflow for each and every year for those 5 years. Okay. Now we have to calculate cumulative cash inflow. This is required for calculating payback period. Okay. I hope you understood everything after that. Let me record how many of you have attended. Okay, thank you, friends. Now we'll move on to the next set of formulas, that is modern techniques. There are 3 modern techniques you have to learn. Okay. The difference between this old method, traditional method, and modern technique is that in modern techniques, we consider depreciation, which is prevailing in the economy. Okay, so whenever we take decision, what we have to consider is the time value of money. What the value of 100 rupees is today will not be there after 1 year. What you could buy today with 100 rupees, you won't be able to buy after 1 year, isn't it? So that is the logic behind these modern techniques, and which is actually logical. Okay, so those are very good techniques. I'll show you how to calculate figures under these methods. So first one, very first thing you have to do is you have to calculate net present value. So you have already calculated cash inflows. Okay. So in the next table, you need not show all the calculations again. you can straightway start with cash inflow column. Okay, so I'll just move this one to my right. Or wait wait for a minute. What I'll do, I'll make a new table. I'll save these formulas for later on. What I'll do, I'll use the format of table and not delete all the words. Instead, I'll paste it down. Okay, that is better. Okay. There are three methods which you have to study in modern techniques. First is net present value method. First one is net present value method. Second method is profitability index method. So is post payback profitability. Third one is which is similar to our payback period method. First method is traditional. Okay. Sorry, discounted post payback period method. Yeah. Okay. Both these methods will get 4 marks each. Okay, 4 marks for this table and each. You will be making 2 tables, so 4 marks each of these 2 tables, so 8 marks. And these 6 formulas will carry 2 marks each. So 12 marks. Likewise, I'm looking for 20 marks. Okay, so that was the first one. These 3 methods, table plus these 3 methods will give you 10 marks. And now, new table plus 3 methods will give you another 10 marks. Okay, now second time when you make the table, you directly start with the cash inflow. Don't show the calculation once again. Okay, so after year column, you will directly have just a minute. Okay, and paste the values. Not allowing, so I'll better write value by myself. Cash inflow. Year one cash inflow is 90,000, 90, 90, 80, 80, and 60. 90,000, 90,000, 80,000, 80,000, and 60,000. Okay. You must very good at keyboard, using the keyboard. Okay. So first column is your cash inflow. We had already calculated cash inflows in previous table, so you can directly use those values. You need not do calculation again. Okay. The second column will be present value factor. I call it PV factor. Okay. For this, they will provide you rate of interest. If we go to the question, see at the end, in D adjustment they have given NPV at 10% discounting factor. Okay, clear? So rate of interest, it will be given in the sum. Okay, so the rate of 10%. Okay, PV factor they have already provided, so you can use the same if given in the sum. Mostly it will be given 0.826, 0.751, 0.683, 0.621. Okay, So discounting factor is given to you. Now next column will be present value of cash inflows. We will multiply cash inflow with PV factor. You will get PVCI, present value of cash inflows. I hope this is clear. This is nothing but multiplication of cash inflow and PV factor. Okay, so I'll do it. 90,000 into 95. Okay. So what does this indicate? This indicates that although in year one you are considering 90,000 as your cash inflow, but considering 10% depreciation or inflation rate, your net in hand cash inflow is only 81,000. Okay, in year two we have inflow of 90,000, but in reality the inflow is only 74,000. Okay, for third year you see that you are having cash inflow of 80,000, but in reality its worth is only 60,000. So this way, these three modern techniques use the discounting factor, that is inflation factor. Okay, decisions taken by these methods are rather more accurate than the traditional methods. Clear, students? Okay. So now again we'll make one cumulative PVCI column. Cumulative PVCI column. Same way, we'll add the values for each year. So opening plus current year's value, and same thing will be repeated for next all the years. I hope this is clear, students. Okay. Now first formula is net present value method. The formula for this is total PVCI, that is present value of cash inflows, minus initial investment. So total PVCI is how much? 308 130 minus initial investment is 2 lakhs. Okay. So net present value is 108 130. Clear? Okay. See, in previous method, in post payback profitability here, you had 2 lakh as your surplus. But in reality, if you consider depreciation, the real surplus is only 1,08,000. Clear? Now, second method, which is very simple one, the formula which was used in net present value. Okay, same variable you have to use, but you have to divide. I'll show you how. Formula is total PVCI instead of minus it will be upon. That's it. That's the only difference. Initial investment. Clear? What you minus in early formula will be divided now. 308 1 upon lakhs. Clear? If your answer is more than 1, you accept the problem. Okay. So your answer comes to, I'll just do the division. 308 130 and on 2. Answer is 1.54. Okay. So here in first method, if your answer is positive more than if it is surplus, you accept the project. Okay. If NPV is positive, then accept project, and if answer is negative, reject the project. Okay, you have to write this sentence, huh, students? Okay. So half mark for this. Okay, for writing this sentence. Okay. So here what we will write? If profitability index is more than 1, except the project. and if it is less than 1, to reject it. Okay, so simple. Okay, now third and last method, which is a discounted payback period method. Okay, which is very similar to your earlier payback period method. Now you have to do the marking in cumulative column, which is closest to 2 lakhs. Can you tell me in which year we are closest to 2 lakhs? Please post in chat box. Let me see how many people understood this method. Tell me the figure or year in which I should do marking in cumulative column. Tell me, should I do marking in second year or third year or fourth year or any other year? Okay. Very good. Shivani, Kashish, Atul. Correct. Okay. Year two, because it is closest to, yeah, Vishara, correct. It is closest to 2 lakh, but does not surpass the 2 lakh. So I'll do markings here and in next year's cash inflow. Clear? Okay. So same formula again. Same formula. Complete years plus okay, same formula. So complete 2 years will be required at least minimum. Plus how much is the shortfall? Shortfall is 2 lakhs minus 156. 150. Okay. Upon next year's cash inflow, cumulative PVCI, not cash inflow, correct? Make correction here. Next year's discounted for PVCI is fine. It is number 60080. 60080. Okay, solve the fraction, students. So it is 2 lakh minus 156, 150. That is 43850 upon 60080. 2.72 years. So it will be 2.73. I'll make it 73 years. Okay, students. So this sum, similar sum will be there. So do attempt it. Very simple sum. 6 methods you have to learn. Okay, to look for 20 marks. Okay. So I'll teach you only this one sum. Tomorrow I'll give one more similar sum in the classroom. Okay, you solve it and share with me. Okay. Tomorrow I'll be taking FA lecture, financial accounting with me. Okay. I'll let you know the timing on the group. Okay. Even today around 30 students joined and 90 students have joined the group. I don't know for what reason they joined. But people have a habit of clicking all the links. Isn't it? ग्रुप का लिंक दिखा क्लिक करो बस अटेंड करना नहीं करना कुछ फर्क नहीं पड़ता okay so tomorrow I'll share the link for a lecture okay so that's it for today thank you students for attending the lecture bye see you take care